One of the Fed presidents talked hawkish on Thursday yesterday, and the stock market is down nearly 3%. Let's see what does it mean in the short term as well as intermediate term. Well, looking at the short-term cycles, the ongoing cycle as of Thursday is 56 days long. Usually these shorter-term daily cycles, of which we usually see several, 3 to 4 to 5, within an intermediate cycle, usually these daily cycles last for a couple of months. So with the ongoing duration at 56 days, today this will turn into 57 days. I think it's very likely that sometime over the next few days, or maybe even over the next 1 to 2 weeks, we will see the daily cycle low and a bit of a bounce to the next daily cycle of the ongoing rally of the new intermediate cycle. But in the very short term, over the next few days, we might still see the general stock markets decline into this FOMC meeting in early May. So wherever this daily cycle low comes at, whether it's 4,300 on the S&P 500 or perhaps even lower if more of the Fed presidents jump up to talk hawkish, in my expectation, at this FOMC meeting, once the rate hike actually takes place for this meeting, we'll see some sort of a sell the rumor, buy the news effect, and then a rally into the new short-term daily cycle, again, within the new intermediate cycle. Whether this rally is going to create a higher high or not, that remains to be seen, but there is a pretty good chance of another higher high before the intermediate cycle tops. So what do you do here? Do you sit out through another few days into that FOMC meeting and hold your positions through this potential decline in the short term? Or do you stop out now with a relatively strong 3% drop as of Thursday to jump back in relatively soon, closer to that early May meeting? Well, that is for you to decide. And me personally, I'll share my opinion with the members at myfinancesteacher.org. where, as you see, I post quite regularly on a range of assets. Let's next have a look at a range of indicators which are relatively important in understanding whether the markets are a little too greedy or too fearful at the moment. Looking at the Optimism Index, we see that at the top of the still ongoing short-term daily cycle, this Optimism Index jumped back up to around 61. Usually intermediate cycles reach some sort of a top when this Optimism Index is a little bit higher, perhaps a little bit below 70. So for that reason, I think there is one more push higher in the ongoing intermediate cycles before we have to reconsider whether a recession due to higher energy prices is going to take place or not. Next, looking at the Fear and Greed Index from CNN, they've changed the chart, which now only goes back to 1 year. Previously, it used to go back for 2 years. And from that more interesting longer history, you could observe that usually intermediate cycles top when this Fear and Greed Index is pretty much into greed territory, somewhere around the level of 70 or sometimes even 80 on the index. And again, recently this Fear and Greed Index only came up to 53 in late March at the top of the ongoing short-term daily cycle. Again, there is one more push higher, but with the decline into the ongoing short-term daily cycle low, this Fear and Greed Index hasn't really dropped much either. It's only declined from 53 down to 43. So in the very short term, perhaps in the next few days or perhaps over the next couple of weeks into that FOMC meeting, we might still see the general stock market somewhat lower and more fear on the markets. That might actually be a slightly better entry point than where the markets are right now. But together with the members at myfinancesteacher.org, we have tried to catch one of these lows for expected intermediate cycle low. So we do have our positions and we aren't in a position to consider whether we jump in right now or not. Lastly, let's have a look at these expectations for the Fed rate hike. Scrolling down a little, we see that even just a week ago, back in mid-April, the markets were leaning much more towards a 2.5% to 3% rate hike by the end of this year. This is by December meeting, rather than into around 3% rate hike, as they are expecting right now. So in my opinion, a lot of the potential rate hikes have already been priced into the markets. Can there be even more hawkishness from the Fed? Can the markets be pushed to expect somewhere closer to 3.5% by the end of this year? Yes, of course, anything is possible and nobody knows the future, but in my opinion, it's not extremely likely. It would be very difficult for the federal government to maintain its huge debts at interest rates anywhere closer to 4%. The expectation is now around 3% by the end of this year. So again, as I mentioned, perhaps much of the hawkishness is priced in. So is it smart to hold through a correction here? Is it dumb to expect the stock market to drop by another 20% over the next couple of weeks? Those are all interesting questions, and perhaps you might want to have a look at what the smart money and dumb money is doing. That's exactly what we will have a look at together with the members at myfinanceteacher.org. For now though, I wish you a nice weekend. Bye bye.